We're just going to unwind everything that happened after the pandemic
Mm-hmm.
and then kind of reassess from there. And that should be, we are going to have a recession. It's pretty clear that that's going to happen. How much has that been priced in? Well, I just did, the year-on-year rate of change of the S&P, I just put it up on Twitter, basically is a predictor for the ISM, which is the predictor for GDP. And the S&P is already pricing in a recession pretty much, as are many things. So it's kind of happening. So therefore, has the damage been done in the stock market already? Possibly. And so therefore, the next side of this is the easing cycle, as I keep saying.
The events of the past months have brought us to this point, a point where severe economic decline is no longer a probability, but our very reality. When the Federal Reserve first announced that it was going to raise interest rates multiple times before the year ends to lower the 40-year high inflation, many experts raised concerns that that might bring the economy of the United States to a grinding halt. Since then, the central bank has raised the benchmark interest rate twice, and the U.S. GDP has shrunk by 1.4%. Markets experts that previously raised concerns that the country might experience a period of recession are more certain now, with many saying there is practically no way to avoid one. In a recent interview, Real Vision CEO and former Goldman Sachs executive talks about the unfolding events in the U.S. economy and how they might or might not affect the cryptocurrency market. We will now take you to Raoul Pal's interview. Ensure you watch the video to the end and drop your thoughts and observations in the comment section below. And don't forget to hit the like button as it helps with the YouTube algorithm. Enjoy the video.
It's a game of musical chairs because the moment that growth slows down or growth is too fast, generally it's when growth slows down. When growth slows down, people need dollar financing and there's less dollars in the system. If the Fed are withdrawing liquidity right now, there's less dollars. So you're taking a few chairs away. First one was Sri Lanka. They're like, where's my chair? Gone. Right? And you'll see one country after another. We're now seeing China starting to devalue its currency. It's because part of their chair's been taken away. One of the chairs has been taken out of the room. So that's what happens is there's too much dollar borrowings. And in a slowdown, people need more debt. And there's not enough debt being given out because the Fed are taking supply out of the market. In the other side, the dollar goes up. The dollar's got a smile. So if the world is growing, generally the US has been the kind of leading world economy in terms of where you want to put your capital. So in a growing world, the dollar tends to do pretty well. The dollar does very well in a slow world. The dollar does terribly in a kind of muddle through reasonable growth world. So it's technology specifically that I'm looking at. We're in a period of we know it from crypto, but it applies to a lot of technologies that I bunched together as the exponential age and a lot of what Cathie Wood looks at, or a whole bunch of other people. These are these technologies like AI, electric vehicles, green energy, space, robotics, genetic sciences. You don't put the genie back in the bottle just because you raised interest rates. The technology keeps moving forwards. So what happens is they actually get cheaper over time if they're trading even sideways. So much the same as crypto, you need to put them into a nice logarithmic channel. And things like Amazon have been in a perfect log channel since it launched. And it sometimes gets 2 standard deviations oversold and maybe 3 standard deviations oversold. And that's usually the sign that you've had a capitulation, unless the network is failing. So Netflix right now, we're questioning, is Netflix a network or is it just a broadcaster where it's on-demand broadcasting? Now, if Netflix developed a community and had a 2-way relationship with its customers and maybe a marketplace, it'll be valued differently. So maybe this is an S-curve moment where everybody questions, is this going to survive or not? And then it changes its business model or it fails. But is Amazon going to fail here? Literally 0 chance. So what we're saying is because of inflation, these stocks are going to get cheap. Because of the interest rate backlog, they're getting cheap. But the ongoing adoption of technology is relentless. So therefore, they're getting cheaper every day. So we should be looking at entries exactly the same we did with crypto. We look at these markets, and if you've got spare money, then you want to be buying this kind of stuff and not selling this stuff because it's the same adoption model. This network adoption models everywhere. And if you stack all of these things on top of each other, all of these technologies, and there's a whole bunch of these things, including crypto, what you've got is a whole bunch of Metcalfe's laws piled on top of each other, which is what's called Reed's law. And it's the fastest pace of change the human race, I think, will ever go through. I mean, it's an extraordinary period of time, and you don't want to get knocked off that game because of what's the volatility in markets. These things are inherently volatile. These logarithmic channels and network adoption models are volatile, but you can't get knocked off your game for this because you're missing the big picture, which is why it's so important not to use leverage in these network adoption models, because you don't want to get washed out at the wrong time.
In his interview, Pal declares that it is now pretty clear that we are going to have a recession. He explains that the markets, including the stock market and others, have already priced in a recession. However, according to the former hedge fund manager, there might yet be some relief for investors. Please listen to the second part of Raoul Pal's interview for this somewhat small ray of sunshine.
We're just going to unwind everything that happened after the pandemic and then kind of reassess from there. And that should be, we are going to have a recession. It's pretty clear that that's going to happen. How much has that been priced in? Well, I just did, the year-on-year rate of change of the S&P, I just put it up on Twitter, basically is a predictor for the ISM, which is the predictor for GDP, and the S&P is already pricing in a recession pretty much, as are many things. So it's kind of happening. So therefore, has the damage been done in the stock market already? Possibly. And so therefore, the next side of this is the easing cycle, as I keep saying. Now, it's not going to happen instantaneously. We're not going to walk in, the Fed are like, oh, we're just going to print another $5 trillion. But over time, they're going to have to stimulate again because the economy's brought back to where it was. As you said, the whole thing has been unwound, and that's the same thing as the prices in equity markets. We don't know what level of pain, but we're getting close to the level of pain where the Fed go, well, I'm not sure about this any longer. The thing
So you believe there's always a safety net. There's never not been a safety net.
Because of the point that I raised before, you cannot allow the collateral to get destroyed because then the whole fucking thing goes under. So you can't. So, which is why I've pivoted my way of thinking about the world from, I was always looking for the rally to sell, the bear market to trade. And I actually think of the bull market to buy, the bear market to buy into because of the structure of how this is, which is they can't let it go fall apart because that's the end of the banking system, the pension system, everything. So it can't happen. So they have to panic at some point if it goes far enough. Usually it's the credit market that freaks them out the most. So, keep your eye on things like HYG, those kind of things. That's what worries the Fed. The equity market's doable. You can go down 40% and not blow up all of the leverage. But the credit market, that's where it all lies. So, I think the Fed put has to be there because if not, it's the end of the world.
Pal has just stated that the Federal Reserve will eventually have to come to the rescue of the over-leveraged banking system if things get too hot. But how long do we continue to survive on the artificial support that is certain to bring us back where we started in the first place? Won't the support have to stop someday and cause more damage than it would now? If you still believe in the continued survival of the traditional banking system and fiat currencies, you will be in for a huge surprise when everything finally falls apart. What are your thoughts on Raoul Pal's interview? Please leave your comments and observations in the comments section below, and don't forget to hit the like button. Thanks for watching.